My whole life was a joke. Not because I failed, not because I was poor, but because I believed the money story exactly the way it was told to me. I believed that if I worked hard, saved responsibly, and followed the rules, the system would take care of me. I believed inflation was temporary. I believed debt was manageable. I believed interest rates were just a technical detail. I believed the headlines. I believed the experts on TV. I believed the simplified version of how money works. And that belief was the joke. This video is not about conspiracy theories. It's not about panic. It's not about hype. It's about something far more uncomfortable, the math of the system itself. And everything I'm going to say, I will separate into three categories only: what is observed, what is likely, and what is unknown. Every major claim will be backed by official data, primary sources, or clearly labeled inference. If I'm wrong, the evidence will expose me. Most people think inflation is just prices going up. Most people think government debt is just a number. Most people think interest rates only matter to banks and investors. That's the story I believe too. Here's the first truth I had to face. The system doesn't run on stories. It runs on arithmetic. And arithmetic doesn't care about optimism, politics, or motivation. Let's start with what is observable. Governments around the world, especially large advanced economies, carry massive amounts of debt. This is not an opinion. This is not speculation. This is publicly reported data from treasuries, central banks, and international institutions. The absolute size of the debt matters less than one specific thing: the cost of servicing that debt. Debt itself is not the trap. Interest is. Every unit of debt comes with an obligation to pay interest. That interest payment is not optional. It is contractual. It must be paid before anything else. And as total debt rises, the interest bill grows, even if rates stay the same. When rates rise, the interest bill accelerates. This is where the story I believed collapsed. I used to think governments could always grow their way out of debt. That growth would magically make everything manageable. But when you look at the data, you see a different constraint forming. Interest payments themselves begin to compete with essential spending. Defense, healthcare, infrastructure, social programs, everything starts fighting for the same budget space. And this is not a future problem. It's already happening. When interest costs rise faster than tax revenue, the system enters a pressure zone. Policymakers are then forced to choose between a small set of options. And here is where the math becomes uncomfortable. There are only three real ways to deal with excessive debt burdens. The first option is cutting spending. The second option is raising taxes. The third option is reducing the real value of the debt. Cutting spending sounds responsible, but it's politically explosive. Large, sustained cuts affect voters immediately. Raising taxes is slow, limited, and also politically costly, which leaves the third option, the one most people don't notice in real time: reducing the real value of debt. This does not mean default in most cases. It means allowing inflation to run above the level of interest paid to debt holders. It means keeping real returns low or negative. It means what economists call financial repression. This was the part I laughed at before I understood it. Financial repression sounds like a conspiracy phrase until you read how often it has been used historically. It simply means policies that channel money in ways that make government debt easier to service. Sometimes this is done through regulation, sometimes through interest rate policy, sometimes through inflation running hotter than officially acknowledged. The key insight is this: if inflation is higher than the interest paid on debt, the real burden of that debt shrinks over time. Savers lose purchasing power. Debtors benefit. The system quietly resets without ever announcing it as a reset. And this is where the joke becomes clear. I was saving in nominal terms. I was measuring success in nominal numbers. I was listening to narratives instead of tracking purchasing power. While I was focused on the surface story, the system was operating on a deeper level, one that rewards those who understand the math and punishes those who don't, even if they do everything right. Now let's slow this down, because this is where people usually get confused. Inflation is not just prices going up. Inflation is a transfer mechanism. It redistributes purchasing power across time. It changes who pays and who benefits. When inflation runs persistently, it erodes the real value of fixed obligations, especially long-term debt. This is observable. You can see it in historical data. You can see it in periods after major wars, during debt-heavy decades, and in modern policy responses to financial crises. What is likely, but must be labeled as likely, not guaranteed, is that systems under sustained debt pressure tend to favor policies that avoid immediate pain, even if they create long-term distortions. Humans respond to incentives. Governments are made of humans. What is unknown is timing. What is unknown is scale. What is unknown is how clean or chaotic adjustments will be. Anyone who tells you they know exact dates or guaranteed outcomes is lying or guessing. And that's another reason I realized I was a fool. I trusted certainty where none exists. The real skill is not prediction. The real skill is understanding constraints. Here is the constraint that matters. Debt plus interest creates a floor under policy behavior. It narrows choices, it forces trade-offs, and once you see that, you stop asking what should happen and start asking what must happen. This is where the money story changes completely. Instead of asking whether inflation will go up or down next month, the more important question becomes, can the system tolerate high real interest rates for long periods without breaking something else? Instead of asking whether debt is bad, the more important question becomes, who ultimately absorbs the cost of servicing it? Once I started asking those questions, the headlines stopped making sense on their own. They only made sense when placed inside the debt interest framework. This is not doom. This is not fear. This is structure. And structure is uncomfortable because it removes comforting illusions. I'm not saying everything collapses. I'm not saying the system ends tomorrow. I'm saying the incentives are visible, the constraints are measurable, and the outcomes are bounded by math, not hope. In the next section of this argument, we'll take this framework and apply it directly to current conditions. Not speculation, not predictions, just data, signals, and scenarios, clearly labeled for what they are. Because once you understand how the system actually works, you stop being the punchline of the joke. Once you understand that the system is constrained by debt and interest, everything else starts to look different. The news, the debates, even the arguments that seem to contradict each other suddenly fit into the same frame. Let's take something most people hear constantly. Inflation is under control, or inflation is temporary, or inflation is coming back. These statements sound like they're about prices, but they're actually about policy tolerance. The real question is not whether inflation exists. The real question is how much inflation the system can tolerate compared to how much interest it must pay. If inflation is lower than interest rates for long periods, debt becomes harder to manage. The real burden grows, budgets tighten, something breaks. If inflation is higher than interest rates, the burden eases over time, quietly, invisibly, no announcement required. This is why focusing only on short-term inflation numbers is misleading. The system doesn't need runaway inflation to change outcomes. It only needs inflation to be high enough, for long enough, to reshape the real value of obligations. This is where I realized how shallow my understanding had been. I used to think central banks were either fighting inflation or stimulating growth. That's the story. But when you overlay debt dynamics on top of that story, you see a different layer. Policy becomes less about ideals and more about managing constraints. When rates rise, interest costs rise. That's not theoretical. It's mechanical. And when interest costs rise faster than revenues, pressure builds, not emotional pressure, budgetary pressure, mathematical pressure. That pressure doesn't disappear, it gets redirected. Sometimes it shows up as higher inflation, sometimes as asset price distortions, sometimes as currency weakness, sometimes as regulatory changes that quietly force savings into certain channels. Different tools, same objective. Keep the system functioning without triggering immediate political collapse. This is why the idea of normalizing policy is so difficult. Normal compared to what? A low-debt world? A pre-crisis environment? The structure today is fundamentally different from decades ago. Pretending otherwise is part of the illusion. And this is where many people fall into another trap. They think understanding this means predicting disaster. It doesn't. Understanding structure doesn't mean panic. It means clarity. Clarity means knowing that systems under constraint behave differently than systems with flexibility. They prioritize stability over optimization. They choose paths of least resistance. They smooth pain over time instead of concentrating it in one moment. That smoothing process is what confuses people. Because nothing dramatic happens all at once. Instead, purchasing power erodes slowly. Returns disappoint quietly. Expectations are adjusted downward over years, not days. This is why so many people feel like they're running in place. They're doing everything right, but the finish line keeps moving. And that's not because they're lazy or stupid. It's because they're playing a game without understanding the rules. Here's another uncomfortable truth I had to accept. Narratives are not designed to educate you. They're designed to stabilize behavior. If everyone fully understood the constraints of the system at the same time, behavior would change rapidly. And rapid behavior change is destabilizing. So the system prefers gradual adjustment, partial explanations, and simplified stories. That doesn't require evil intent. It's a natural outcome of large, complex systems trying to preserve continuity. Once you see that, you stop expecting honesty in the form of full transparency. You start looking for honesty in the form of data consistency. Does the policy make sense given the constraints? Does the action align with the incentive? Does the explanation match the outcome over time? Those questions matter more than speeches. This is also where people get distracted by extremes. One side says everything is fine forever. The other side says everything collapses tomorrow. Both are comforting in their own way. One offers reassurance, the other offers drama. Reality usually lives in the boring middle. The system grinds, it adapts, it shifts costs, it avoids clean endings. That grinding process is what most people misinterpret as chaos. It's not chaos, it's adjustment under pressure. Now let's talk about why this matters to you personally, because abstract understanding without application is just another form of entertainment. When you don't understand the debt interest mechanism, you measure success in the wrong units. You focus on nominal growth instead of real outcomes. You celebrate returns that don't beat inflation. You underestimate risk when policy shifts. You also fall for false binaries: cash versus assets, inflation versus deflation, growth versus collapse. These are oversimplifications. The real question is always relative. Relative returns, relative purchasing power, relative flexibility. Flexibility is the hidden variable. Entities with flexibility adapt. Entities without it absorb costs. Governments increase flexibility through policy tools. Large institutions hedge. Individuals often don't. Not because they can't, but because they're not taught to think this way. I wasn't taught either. I was taught to save first and ask questions later. I was taught that stability was the default state. I was taught that systems self-correct cleanly. Those lessons work in low-debt environments. They break down under high-debt constraints. And this is where the joke turns into responsibility. Once you see the structure, you can't unsee it. You can't go back to consuming financial content as entertainment. You can't accept simple answers to complex problems. You can't outsource thinking to headlines. That doesn't mean you reject everything. It means you filter everything. You ask, what assumption is this argument relying on? You ask, what constraint is being ignored? You ask, who benefits if this continues? Those questions don't make you cynical. They make you grounded. Now, there's an important distinction to make here, and this is where many channels lose credibility. Understanding constraints does not mean claiming inevitability. There are always multiple paths forward. Growth can reduce burdens. Innovation can change productivity. Policy can shift. External shocks can reset conditions. History is not a straight line. What understanding gives you is not certainty, but boundaries. You stop believing in impossible outcomes. You stop being surprised by predictable ones. And that's the real value. In the next stretch of this argument, we're going to take everything we've discussed so far and map it into clear scenarios, not predictions, scenarios. We'll identify what signals matter, what signals don't, and how to tell the difference. We'll separate what is observable today from what is merely assumed, and we'll talk about how to navigate a system that isn't broken, but isn't free either. Because once you stop believing the money story as it's told, you finally get the chance to understand the money system as it actually is. To move from understanding to usefulness, we need to stop talking in generalities and start talking in structure, because structure is what turns awareness into decision-making. Right now, most financial conversations revolve around surface indicators: monthly inflation prints, central bank statements, market reactions. These things matter, but only in context. On their own, they create noise. When you place them inside the debt interest framework, they become signals. Let's define what a signal actually is. A signal is not a headline. A signal is not a prediction. A signal is a measurable change that alters the constraints of the system. That distinction matters. For example, a temporary drop in inflation does not change the structure if debt continues to grow and interest costs continue to rise. A single rate cut does not restore flexibility if servicing costs remain elevated. A rally in asset prices does not fix purchasing power if real incomes lag. This is why people feel whiplash. They react to movement without understanding direction. So let's map the system into 3 clear scenarios, not because one of them will definitely happen, but because every possible outcome must fall into one of these paths. The first is the base scenario. The second is the upside scenario. The third is the stress scenario. The base scenario is the most boring, and that's why it's the most likely. In this scenario, the system continues to manage debt through gradual adjustment. Inflation runs at levels that are uncomfortable but not catastrophic. Interest rates fluctuate but remain constrained by the cost of servicing debt. Growth exists, but it's uneven. Purchasing power erodes slowly rather than collapsing suddenly. This scenario doesn't feel dramatic. It feels frustrating. People work harder for the same outcomes. Savings don't compound the way they used to. Asset prices appear disconnected from fundamentals. And the explanation is always that things are complicated now. They are complicated, but not random. In the base scenario, policymakers avoid extremes. They don't want runaway inflation, but they also can't afford prolonged high real rates, so policy oscillates. Tighten slightly, ease slightly, adjust messaging, adjust expectations. The key signal in this scenario is not a single number. It's persistence. Persistent inflation relative to income growth, persistent pressure on budgets, persistent reliance on refinancing rather than reduction. If you understand this, you stop waiting for a dramatic turning point that never comes. The second scenario is the upside scenario. This is the one people hope for, and it's not impossible. In this path, productivity growth accelerates, innovation drives real output, debt becomes manageable not because it disappears, but because the economy grows faster than the burden. This scenario requires conditions that are hard but not unthinkable. Structural reforms, efficient capital allocation, technological breakthroughs that translate into broad productivity gains, not just asset inflation. The signal here is real growth, not nominal growth. Rising productivity per worker, wage growth that outpaces inflation, sustained increases in output without corresponding explosions in debt. This scenario doesn't come from optimism. It comes from execution. And here's the uncomfortable part. You don't get to assume this scenario by default. You have to watch for evidence. Hope is not a signal. The third scenario is the stress scenario. This is the one people argue about endlessly, usually in exaggerated terms. It doesn't require total collapse. It simply requires a failure to manage constraints. In this scenario, interest costs crowd out spending. Policy loses credibility. Inflation expectations become unanchored. Capital becomes defensive. Volatility increases. Adjustments that were previously gradual become compressed. The signal here is not panic in markets. Panic is late. The signal is dysfunction, failed debt auctions, emergency interventions, sudden rule changes, controls that were previously unthinkable becoming thinkable. Most people only notice this scenario once it's already unfolding. That's why it feels sudden. Now, here's the part that matters most. None of these scenarios are moral judgments. They are mechanical outcomes based on incentives and constraints. And this is where personal decision-making enters the picture. When you understand structure, you stop trying to outguess the system. You focus on positioning yourself relative to it. You stop asking, what will happen? You start asking, what happens if? What happens if inflation stays above my income growth? What happens if real rates stay low? What happens if volatility increases? Those questions lead to preparation, not panic. Preparation does not mean extreme bets. It means flexibility. Flexibility means optionality. It means not locking yourself into a single narrative. It means understanding which assets, skills, and choices benefit from which scenario. This is where many people get misled by absolutism. They're told to go all in on one outcome. All cash, all assets, all risk on, all defensive. That's not intelligence. That's belief disguised as strategy. Real strategy acknowledges uncertainty, and uncertainty doesn't paralyze you. It sharpens you. Now let's talk about one of the biggest illusions in the money story, the idea that stability is the natural state of the system. Stability is not natural. Stability is managed. It requires constant adjustment, intervention, and compromise. When debt levels are low, that management is subtle. When debt levels are high, that management becomes visible. This is why policy feels contradictory, why messages change, why frameworks evolve. The system is responding to pressure in real time. Understanding this doesn't make you distrustful. It makes you literate. Literacy is the difference between reacting and responding. Once I understood this, I stopped consuming financial content for reassurance. I started consuming it for information density. I stopped asking who sounded confident. I started asking who acknowledged constraints. That shift alone changed how I see everything. It also changed how I judge claims. Any argument that ignores debt dynamics is incomplete. Any forecast that assumes linear outcomes is fragile. Any promise that guarantees certainty is selling comfort, not truth. This doesn't mean expertise is useless. It means expertise must be contextual. And this is why so many people feel betrayed by experts. Not because experts are lying, but because their models are often built on assumptions that no longer hold. When assumptions change, outcomes change. That's not failure. That's reality. Now, let's bring this back to the title of this video. My whole life was a joke is not an insult to myself. It's a recognition that I was playing a serious game with a cartoon rulebook. I thought the goal was accumulation. I thought the metric was nominal growth. I thought the system was neutral. It isn't. The system has bias. It has momentum. It has constraints. And once you see them, you stop blaming yourself for outcomes that were structurally influenced. That realization is liberating, not depressing. It means you stop chasing illusions and start building resilience. Resilience doesn't come from predicting the future. It comes from understanding what can't happen, what is unlikely, and what is plausible. It comes from aligning your decisions with reality instead of narratives. And that's the real point of this video, not to scare you, not to convince you of one outcome, but to give you a framework that prevents you from being fooled. Because the biggest cost in the system is not inflation or debt or volatility. The biggest cost is misunderstanding. When you misunderstand the system, you give up agency. You react late. You trust the wrong signals. You chase explanations instead of structure. When you understand the system, you don't need perfect information. You need consistent logic. And that logic starts with one simple realization. The money story you were told was incomplete. Not because someone wanted to deceive you, but because simple stories are easier to live with than complex truths. Now you have a choice. You can keep consuming the story as entertainment, or you can use the structure to think for yourself. This channel exists for the second option. Not hype, not fear, not promises, just structure, evidence, and honest uncertainty. If you want to understand how the system actually works and how to navigate it without illusions, stay with me. The next step is learning how to read the signals before the story changes.